Warren Buffett was sitting on $167 billion in cash in early 2025. Not index funds, not treasury bonds, cash. And every quarter, Wall Street analysts wrote pieces explaining why this was a mistake, why the Oracle of Omaha had finally lost his edge, why holding that much dead money was costing Berkshire Hathaway shareholders billions in foregone returns. Then markets got volatile. And suddenly, the most mocked position in finance became the most powerful seat in the room. Here's what those analysts never explained to you. Buffett was not holding cash because he did not know what to do with it. He was holding it because cash is not what most people think it is. Cash is not savings. Cash is not a low return asset class. Cash is a free, permanent, open option on literally every asset on earth. And that framing changes everything about how you should be building wealth. Most financial advice you have ever received was built on one hidden assumption. The goal is to minimize the time your money spends doing nothing. Maximize deployment. Stay fully invested. Never let a dollar sit idle. And here's the thing, that advice makes perfect sense if you are a fund manager being paid a fee on assets under management. For you, the individual, it is one of the most expensive pieces of advice you will ever follow. I have been running my own business for over 10 years. I have spent those years surrounded by accountants and fiscal lawyers and people who make their living understanding how money actually moves, not how it looks in a Vanguard brochure. And the single thing that surprised me most when I started earning real money is how obsessively the sophisticated people around me talked about liquidity. Not returns, not alpha, not picking winners. Liquidity, having cash, keeping cash, protecting cash, the thing everybody tells you to avoid. I currently have multiple hundreds of thousands of dollars invested, so this is not theory. This is what I actually do. And why? By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report, so I don't store any of your financial data link in the description. So here is what this video is about. I want to explain the actual mechanics of why cash is the most misunderstood financial instrument most people will ever hold. Not in a, you need an emergency fund way, your grandmother already covered that. I mean, in the sense that cash functions as a free, perpetual option on every opportunity you will ever encounter. And people who understand this build wealth in a completely different way than people who don't. There are 3 levels to this. Most people only understand level 1, which is precisely why most people are getting it wrong. Here's the central idea I want you to carry through this entire video. Think of cash as ammunition, not as money sitting there losing purchasing power to inflation. Think of it as rounds loaded in a chamber. When you are fully invested, every dollar deployed, every account maxed, every asset working, you are a soldier in a firefight with an empty rifle. You look the part. You have the gear, the vest, the right terminology, but you cannot shoot. And that is fine, right up until the moment you need to pull the trigger. The ammunition metaphor is going to come back. Keep it in your head. In a few minutes, I'm going to show you a piece of math that financial advisors really genuinely hope you never do, because when you actually run the numbers on the cost of illiquidity versus the cost of holding cash, the conventional wisdom completely inverts. But first, let me explain why the entire system is set up to make you feel guilty about holding cash, and why that guilt is the most expensive emotion in personal finance. There is a reason every financial calculator on the internet shows you the same thing. Type in, I have $100,000 in cash, and it immediately calculates how much you are losing to inflation. 3% per year. After 30 years, your purchasing power is roughly cut in half. The implication is obvious. Invest or you are losing. Every tool, every interface, every default setting in personal finance nudges you toward deployment and away from holding. You know what none of those calculators show you? The cost of a margin call. The cost of selling your index fund at a 40% loss in a panic to cover 3 months of bills because you never built a real cash reserve. The cost of staying in a job you hate for 4 extra years because you have no financial runway to take a risk. The cost of watching a once-in-a-decade opportunity walk right past you while your money sits locked in assets You cannot liquidate fast enough. Those costs are invisible in the calculator. They are enormous in real life. Now I want to walk you through the 3 levels of cash power, because not all cash is doing the same job. And the reason most people get this completely wrong is that they conflate all 3. Level 1 is survival cash. This is the 6 months of expenses that everybody already tells you to have. Defensive, the buffer against your car needing an engine or your roof deciding to become decorative. This is your rifle loaded with 6 rounds, enough to not be completely helpless, not enough to go on offense. Most people either do not have this at all, or they have it, but they count their brokerage account as part of it, which is a category error that will destroy you at the worst possible moment. Your brokerage account is not worth its current market value when you need it in a crisis. It is worth whatever someone will pay for it on that specific day, minus taxes, minus the emotional cost of selling at the wrong time. Level 2 is stability cash. This is the layer nobody ever talks about. An additional 12 to 24 months of expenses on top of your survival cash. This is the layer that creates walkaway power. This is what makes your job a choice rather than a sentence. This is what lets your investment portfolio drop 40% while your blood pressure stays completely flat. This is not a safety net. This is a negotiating position. This is ammunition for a long campaign, not a single firefight. Level 3 is offensive cash. This is what Buffett was doing. This is the capital you are consciously holding back from the market because you are waiting for something worth buying, not because you are scared, not because you don't understand compound interest, because you understand that the best opportunities in investing do not appear every day. They appear every few years, during moments of maximum fear when everyone else is completely out of ammunition and you are still loaded. Here is where it gets really interesting, because most of the conversation about cash stops at level 1, and that is exactly where the system wants it to stop. Let me tell you about something that happened in the winter of 2023, when layoffs hit the tech industry so hard and so fast that the phrase tech layoffs was trending almost continuously for about 4 months. You had 2 distinct groups of people affected. Both groups were educated, well compensated, financially literate by any normal standard. Group 1 had done everything right by conventional metrics. Maximized their 401k contributions, bought index funds, had some company stock vesting. On paper, solid. Group 2 had made choices that looked less impressive. They kept 12 to 18 months of expenses in cash or high yield savings. By conventional wisdom, they had left money on the table. When the layoffs hit both groups, what happened was not subtle. Group 1 had to move within 60 to 90 days. They took the first offer that came. Some sold investments at bad moments. One pattern that showed up repeatedly in reporting from that period, people who were not broke, who had positive net worth, who were fine on paper, were accepting roles at 15 to 25% below their previous compensation because they needed health insurance and income, and they needed it immediately. They had assets. They had no ammunition. So they negotiated from an empty rifle. Group 2 waited. Some took 4 months, some 6. They interviewed widely, turned down bad fits, negotiated hard on the right role because they did not need it desperately. The average outcome in documented cases, better jobs, better titles, meaningfully higher compensation, not because they were smarter, because they had cash, because they had walkaway power, because when the negotiation got uncomfortable, they could say no and mean it. That is not an emergency fund story. That is a leverage story. Most people are confusing the two. Now, walkaway power does not operate only in job markets. It operates everywhere. Money and human psychology intersect, which is essentially everywhere. Think about what happens in a real estate negotiation when you show up with pre-approved financing and a 60-day close versus showing up with a cash offer and a 2-week close. The second buyer gets the deal at a lower price every time. Research from the National Bureau of Economic Research found that all cash home buyers pay on average 11% less for equivalent properties. 11% on a $400,000 house. That is $44,000 back in the buyer's pocket. Not because of any investing sophistication, because they had ammunition loaded when they walked in the room. Or think about a small business. I have watched this play out in my own business and in the businesses of people around me. When you have cash in the business, you can pay suppliers faster in exchange for better pricing. Net 30 terms with a 5% discount for immediate payment is, on an annualized basis, roughly a 60% return on that cash. No conventional investment gives you that on a guaranteed, reliable basis. But you can only access it if the ammunition is sitting there, ready. If your working capital is stretched, you are paying full price, waiting the full 30 days, and your cash flush competitor is getting 5% off, plus whatever additional discount they negotiated because they could afford to negotiate. Now you are asking yourself, okay, but what about the inflation argument? What about the compounding I'm missing? I hear you, and I am not dismissing it. But let me show you the math that never gets run. The inflation argument goes like this. You hold $100,000 in cash, inflation runs at 3% annually. After 10 years, your purchasing power is approximately $74,000 in today's terms. You lost $26,000 in real value. Terrible. The calculator is not lying to you. Here's the part the calculator omits. Scenario A, you are fully invested. The market drops 35%, which it did in 2008, which it did in 2020, which it will do again in some form because it always has. You have an emergency, job loss, medical event, whatever. You need $40,000. You liquidate your index fund at a 35% discount. That $40,000 in shares hands you approximately $26,000 after the markdown. You just absorbed a $14,000 hit to timing you did not choose, but the compounding cost is the part people never calculate. Those shares, held through recovery based on historical post-crash return patterns, would have been worth approximately $70,000 to $80,000 5 years later. So the real cost of that forced sale is not $14,000. It is closer to $40,000 in lost future value from one bad moment of illiquidity. Scenario B, you hold the stability cash, same emergency. You cover it from cash. Your investments sit untouched. They drop 35%. You feel nothing except mild interest in what to buy. You deploy $20,000 of your cash at the trough. Based on historical post-crash recovery periods, that $20,000 becomes somewhere between $50,000 and $60,000 over the following decade. You turned a crisis into a purchasing event. Same income, same emergency, same market, $60,000 difference in outcome at minimum. That gap is not theoretical. That gap is the cost of following advice that was optimized for someone else's incentives. This is a good moment for the subscribe button, by the way. Hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. I want to introduce you to Marcus, because Marcus is a character I have watched play out in real life enough times that he might as well be a recurring character in a documentary about financial decisions. Marcus is 41 years old. He earns good money, call it $160,000 a year. He is genuinely thoughtful about money. He reads about it. He tracks his net worth. He maxes his 401k. He has a diversified brokerage portfolio. His financial advisor thinks he is a model client. His total net worth is somewhere around $850,000. Here is Marcus's actual situation. Of that $850,000, about $680,000 is in retirement accounts and brokerage. His house has roughly $150,000 in equity. He has about $20,000 in cash, $20,000. His monthly expenses, mortgage, kids, subscriptions, the whole modern life package run about $7,000. So Marcus has less than 3 months of expenses in liquid cash. He has $900,000 in net worth and 3 months away from financial stress. His company starts struggling. Management gets scared. Bonuses disappear. Culture deteriorates. Marcus is miserable, but Marcus cannot move. His lifestyle requires his income. His cash gives him less than 90 days of runway. And in this job market, that is not enough time to be picky. So Marcus stays. He stays for 2 years longer than he should. He grinds through it. He gets out eventually. But those 2 years cost him in ways that compound in stress, in career drift, in the kind of slow erosion that happens when you are too financially cornered to make bold moves. Marcus had a full rifle and no ammunition. Now let me tell you about the person who was in Marcus's graduating class. Similar career trajectory, similar earnings. I will call him Daniel. Daniel never quite maximized his 401k. His investment portfolio is smaller, his net worth number looks less impressive. But Daniel kept 20 months of expenses in cash and high yield savings, plus a separate account he called his Opportunity Fund, about $40,000 that he never touched unless something genuinely interesting appeared. When Daniel's employer started the same restructuring spiral, Daniel quit. He quit with a timeline. He took 5 months to consult, to be deeply selective, to turn down 2 offers that were not right. He negotiated hard on the third because he did not need it. He ended up with a 31% salary increase. Now you might think, okay, Daniel's investment portfolio missed 5 years of returns that Marcus's maximized portfolio captured. Daniel's behind. Except the math does not work that way. The compounding effect of a 31% salary increase sustained over the subsequent decade, plus the better opportunities that tend to follow better positions, plus the absence of 2 years of career stagnation, the numbers go in Daniel's direction. And they go there significantly. The offensive cash did not cost Daniel money. It made Daniel money. This is the part of the cash conversation that never gets calculated. The return on walkaway power is not captured in a yield. It shows up in your career trajectory, your business decisions, your negotiating outcomes, and the quality of the choices you make when you are not operating from desperation. Here is your pattern interrupt. The amateur investor optimizes for maximum deployment. The sophisticated investor optimizes for maximum optionality. Those are different functions, and they produce different lives. Let me talk about the institutional side of this for a minute, because I want you to understand the structural incentive problem clearly. Financial advisors, as a profession, are paid on assets under management. The industry standard is roughly 1% per year on what you have invested with them. Think about what that means for the advice they give you. If you have $300,000 invested with an advisor and you say, I am thinking about keeping $60,000 in cash as an opportunity fund, your advisor has a very natural, very human, and very financially self-interested reason to talk you out of it. They will use technically accurate arguments, inflation, foregone returns, the importance of staying invested through volatility, all legitimate points, all conveniently aligned with their revenue. I want to put a specific number on this because I think specificity is the thing that actually moves people. Over 30 years, a 1% annual fee on $200,000 costs you approximately $170,000 in lost compounding. That is not a rounding error. The same advisor who costs you $170,000 in fees over your investing lifetime is advising you to stay fully invested rather than hold cash. I am not calling them villains. I am saying their optimization function and yours are not the same. They have never been the same. Now here's where I want to introduce the part of this conversation that actually changed how I think about all of it. In 2020, when retail investors were panic selling, when brokerage platforms were crashing from volume, when the CBOE volatility index hit 85, which is levels not seen since 2008, sophisticated institutional money was buying everything available. Private equity firms closed more deals in the second half of 2020 than in any comparable period in the prior decade. Family offices that had maintained meaningful cash reserves were deploying simultaneously into real estate, distressed debt, and equities. Buffett had approximately $137 billion in cash going into 2020. He moved more cautiously than people expected, which is a separate interesting story about his patience, but the structural principle is what matters. The most sophisticated long-term capital in the world maintained the largest cash reserves, not despite understanding compound interest. Because of it, there is a story about Japanese trading companies, the Sogo Shosha, that Buffett actually invested in heavily, starting around 2019 and 2020. Companies like Itochu and Marubeni. One of the things these companies are known for, which is somewhat unusual in global corporate finance, is maintaining massive, almost absurd-looking cash positions as a permanent structural feature. Not because they lack investment ideas, because their model is built on the ability to act instantly on opportunities that appear in global commodity markets, shipping, real estate, and trade finance. Their cash is not dead. Their cash is the weapon. Buffett recognized the model because it is essentially what he has always done. The countries and companies and individuals that have dominated long-term wealth creation do not share a stock-picking philosophy or a particular asset allocation formula. They share one thing: They were loaded when the right moment came. Imagine a poker player. Sit with me on this for a second. When you have the biggest stack at the table, the dynamic of every hand changes. You can outlast anyone. You can bluff with credibility because the threat of your resources is real. Small stack players do not have the luxury of patience. They have to go all in at bad moments or get blinded out by the cost of waiting. They make suboptimal decisions under structural pressure. The structure of the table is the structure of capitalism. The people with the most chips, the most liquidity can afford to play optimally. Everyone else is reacting to their circumstances. Financial stress is the blinds eating your stack when you have no ammunition left to work with. Financial advisor, in my imagination, hearing all of this, but Tom, you cannot just tell people to sit on cash. Inflation is real. Time in the market beats timing the market. The data is very clear. And yes, theoretically. But tell me about the data on forced selling. Tell me about the data on career decisions made from desperation versus options. Tell me about the 30-year compound effect of consistently making better choices because you were never negotiating from an empty rifle. The data on that does not exist in any calculator because no one is trying to sell you a product where the punchline is hold more cash. Somebody once asked a very old, very wealthy man how he got rich. He said, "I never sold anything when I needed to. I only sold when I wanted to." That is the entire thesis. The cash made him want to sell rather than need to sell. And that difference, compounded over decades, is the actual engine of the wealth. Now you might think, this sounds great, but you cannot tell me what percentage of my net worth should be in cash. And you are right, I cannot, because it depends on your income stability, your opportunity exposure, your risk tolerance, and a dozen other variables. But I can tell you that the standard 3 to 6 month emergency fund is almost certainly not enough to give you the level 2 and level 3 benefits I have been describing. And I can tell you that if the number feels too high to reach right now, the right move is to have a target and build toward it with the same intentionality you apply to your investment contributions. There's also a yield point worth addressing because I hear this objection constantly. In 2024 and into 2025, high yield savings accounts and money market funds were paying somewhere between 4 and 5%. Treasury bills were yielding similarly. The traditional argument against holding cash that it earns nothing became significantly less accurate during this period. That is true, but here is why the yield is not the main point. The yield on your cash is a bonus. The optionality is the asset. Whether your cash is earning 5% or 0.5% is secondary to whether it exists at all. Because the opportunity that cash enables the distressed purchase, the career pivot, the business negotiation, the deal made from strength, those events produce returns that make the yield conversation look like a rounding error. A 40% discount on an asset bought during a crash is not correlated with what your savings account was paying last Tuesday. And one more thing, because I want to be honest about the psychological dimension of this, because I think it is where the most money actually lives and where the conversation almost never goes. There is a well-documented phenomenon in behavioral economics called present bias. Humans dramatically overweight immediate visible costs versus abstract future benefits. The immediately visible cost of holding cash, the inflation rate on the screen, the returns you are missing, the mild guilt your advisor generates is psychologically vivid. It registers. The future benefit of having cash when you genuinely need it, the negotiating leverage, the crisis purchase, the walkaway moment is completely abstract until the moment it is not. And when it becomes concrete, it is usually at a moment of high stress when you have the least capacity to make good decisions anyway. Daniel Kahneman's research, published in Thinking Fast and Slow Nobel Prize, 2002 in economics. Real credentials showed that humans under financial stress make measurably worse decisions across every domain. Not just financial decisions, medical decisions, relationship decisions, judgment calls at work. Scarcity of resources narrows cognition in a measurable, documented way. When you have real cash reserves, you are literally operating with more cognitive bandwidth. That is not a metaphor. That is what the research shows. So the reversal I want to hand you is this. You think the problem is that you are not fully invested. The actual problem is that you are making your biggest financial decisions in a state of partial cognitive impairment because you have no cash buffer. The fix is not a better stock screen. The fix is the ammunition. Let me give you the 3 practical things to do with all of this, because I'm genuinely uninterested in leaving you with a vague, warm feeling about cash. First, separate your cash into the 3 piles and size them with real numbers. Survival cash. 6 months of actual expenses, not optimistic estimates. Actual expenses in an account you do not have to sell anything to access. If liquidating something is required to reach it, it does not count. Stability cash. An additional 12 months minimum. Treat this as your walkaway fund. This is what converts your job from a sentence into a choice. Your business relationships from desperate to voluntary. Your investment portfolio from a source of anxiety into a long-term vehicle you can actually hold through volatility. Offensive cash, a separate bucket sized to the specific opportunities you are positioning for. If you want to deploy capital during the next market dislocation, what do you want to have available? If you want to make a real estate move, what does a down payment on a distressed property look like? That number is your target. It does not need to be funded today, but you need to know what it is. Second, change the opportunity cost calculation you are using. Every financial decision that involves fully deploying capital should carry a mental adjustment for the liquidity premium, the value of the option you are giving up by locking money into an illiquid asset. When you are choosing between investing an extra $50,000 or holding it, you are not choosing between $50,000 of investment return and zero. You are choosing between $50,000 of investment return and $50,000 of perpetual optionality on every opportunity you will encounter in the coming years. Price that correctly. The calculator that shows you foregone returns is not wrong. It is just incomplete. Third, audit the incentives of whoever is giving you financial advice, not conspiratorially analytically. What does your advisor earn if you stay fully invested? What do they earn if you hold more cash? What do the tools and calculators you use earn? Financial advice is a product like any other product, and the rational way to evaluate a product is to understand what the seller is optimizing for. If their optimization and yours are not aligned, adjust the weight you give their advice accordingly. Marcus, by the way, eventually got out of his bad situation. It took him approximately 2.5 years longer than it needed to because he did not have the financial runway to move faster. He is fine now. But those 2.5 years cost him in ways that genuinely compound in stress, in opportunity drift, in the career stagnation that accumulates when every decision has to go through the filter of, can I afford to take this risk? The answer was almost always no. He had a full rifle and no ammunition. He got out eventually. He would have gotten out sooner, better, and into a stronger position if he had kept the ammunition loaded from the start. Daniel is doing well. No surprise. The financial system is very good at showing you the cost of inaction on investing. It is very bad at showing you the cost of inaction on liquidity. Nobody has built the calculator that shows you the compound benefit of a career decision made from strength instead of desperation, or a property purchased at a 40% discount because you had cash when nobody else did, or a decade of better sleep and cleaner thinking because your nervous system was not calibrated to permanent scarcity. Those returns are real. They are large. They are simply invisible in the tool optimized for assets under management. That gap in the information is not accidental. It is the most expensive, invisible tax that financially literate people pay. And most of them never even notice it because the bill does not arrive in one place. It arrives in slow career drift, in suboptimal negotiations, in missed opportunities, in decisions made from fear when they should have been made